Every day trader is looking for ways to minimize risk while maximizing the potential reward on their trading ideas. I'm the head trader of SMB Capital's options trading desk here in Manhattan, and the day traders on our desk will often ask me for advice on how to express trading ideas that they have using options to help them to cut the risk on a trade while keeping the potential reward of the trade largely intact. In today's video, we're going to be going over an example of how traders who use overnight futures price action to establish price levels can set up an easy to understand and powerful options trading strategy to exploit a trading idea without taking much risk. So stick around. I think you're going to be interested in what we've come up with here. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so as you might know, some very talented traders like to observe the overnight price actions of futures contracts in order to help them make decisions about where they might want to enter a day trade. Those kinds of traders like to find key support and resistance levels and then design trades around those levels using futures contracts. So let's take a look back at the market on June 26th. And you can see that the S&P 500 index, which trades under the symbol SPX, had closed the previous day at 3083. So based on the overnight price action of the S&P futures contracts, also known as the E-mini futures contracts, a trader could have established certain key support and resistance levels to help them make decisions about where to go long and short on trades, as well as where to set their stops. And so based on that overnight action of June 25th into the morning of June 26th, a trader could have set up the following simple trade plan for the day. The trader observed that any pre-market rallies were failing at the equivalent of the SPX index range of 3088 to 3092. And to the downside, the trader had also established the 3064, 3070 level of support. And so the simple plan was to go long if the market were to rally decisively through the pre-market resistance level, and to go short if the market broke down convincingly below the pre-market support level that he defined. So now let's move to the opening bell on the next day, and we can see that the SPX opened up at 3066, and by 9:45, the SPX had dropped below our support range, 3064 to 3070, down to 3061. And so according to our plan at this point, we're going to go short. Now, we could go short by simply selling an E-mini futures contract, but there's a safer way to make this trade, and that is through the use of SPX index options. Now, before we show you how we could have structured this trade, we need to make sure that everyone understands how index options work. Now, for those of you who know how they work, don't worry, this is going to be quick, and then we'll get right back into the options trade structure that could have worked very nicely in this case. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is to get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if an index is trading at 1400 and you buy the 1410 call, if the index goes to 1415, you'd make $500 into your account. If the index closes at 1410 or lower, on the other hand, your call expires worthless. On the other side of the ledger, if you buy a 1385 put and the market sells off to 1375, you'd make $1,000. But if the market just sold off to 1385 or higher, the put expires worthless. Okay, so those are the basics of index options. And remember, you can buy options, but your broker will also allow you to sell options. And your broker will allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that's advantageous to you as a trader. Okay, so with that as background, we can now take a look at an options trade that could have been structured around this idea of going short once that 30.64 to 30.70 range had broken. So first, we're going to go to the top of that range at 30.70 and sell a call that is going to be expiring that day. And then for protection, we'll buy 25 points away above that, a call for 30.95. Then we'll head down to the 30.40 strike on the put side, and we're going to buy one of those puts. Now, you might be asking yourself, why not just buy the put at 30.40? Because puts will go up in value if the market sells off, right? Why play around with those calls on the other side of the trade? And the answer to that is when you sell that call closer to the market price at 30.70 at the top of your support range that broke down, and you buy that call up at 30.95, you get cash into your account for that part of the trade, because the call you sold closer to the market costs more to the buyer of it than the call you bought farther from the market naturally. And while you'll expend most of that cash on buying the put at 30.40, you'll soon see that you still have a small amount of cash left over. Now let's first examine the cash flow of what has happened here, and then we can explore how the trade works exactly. So we paid $2.98 for the long call at 30.95, as you can see. And remember, that call is worth $100 per point above the 30.95 call strike price. And so you multiply that by 100 for a total cost of $2.98. Now we sold that 30.70 call for $10.10. And so as you can see by that calculation, that brought in $1,010. And then when we went down to that 30.40 put, the one that we're hoping will become activated by a large sell-off, we paid $6.95 for that one for a total cost of $6.95. So when you net everything down, you actually end up bringing in $17 in cash as a credit into your account.
I wanted to let you know that there really are sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective technique that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
Let's get back to the trade. Remember, now we've established that we actually received $17 in cash when we first entered the trade. Well, that's a pretty significant fact if you think about it. You see, the main idea behind this trade is that once having broken support, we expect a potentially large move down. And the real driver of profit in this trade is that 30.40 put, because it will explode in value if the market keeps selling off, as the market begins to value more and more the right to receive $100 per point if the market moves below 30.40. But there's an equally important point here, and that is that if the SPX doesn't sell off any further, and in fact the SPX rallies back from here another 8 to 9 points, then at the end of the day, not only did we not lose money on the trade, even though we lost our bet that the market was going to go down, but we actually made $17, the cash we received in the first place. So let's hypothetically analyze what happens if the market didn't sell off, but instead rallied 8 points from the time we entered it up to 30.69. In other words, let's analyze the impact of this trade going against us. Well, let's take a look at the end of the day values of each of the options in that hypothetical scenario. Because remember, these options expire at the end of the day, so we can know with certainty what their value will be at the end of the day. And as you can see, the 30.95 call, which is 26 points above the close of 30.69, that one expires worthless. It has no value because the seller of the call has no obligation to pay out anything because the market did not reach its strike price. But that 30.70 call, which is one put above the market close, also has no value for the same reason. The market didn't close above its strike price either. And then, of course, the 30/40 put, well, that expires worthless also because the market actually never sold off and, in fact, rallied. And so that put is not going to be activated either, obviously. So even though at this, and this is a really crucial point, the premise of your trade was wrong, even though you were wrong, you ended up making money on the trade simply by virtue of the fact that you received a credit initially for getting into the trade. So the beauty of this approach is that as long as you're not terribly wrong and you start having to pay out under your 30/70 call, in which case you'd exit the trade at a predetermined stop that you would choose anyway, even if you're slightly wrong on the direction, you'll still make a little bit on the trade. But if you're right, it can get pretty great. So let's move now to the end of the day. And as you can see, the SPX index closes at 3010. And so we were right about direction. So now it's time for these options to be settled. And let's take a look at how each one turns out. Well, again, the calls, both the 30.95 and the 30.70 each have no value because they only pay off if the market is above their strike price. But in this case, the market is way, way below the strike price, so those go out worthless. But the put that we bought, the 30.40, well, that's what we call in options trading an option that has expired in the money, meaning it has value. And it has value in this case because the market closed at 30.1040, and this is a put, so it pays off $100 per point for every point below its strike price of 30.40. Well, the market closed in reality at 29.4 points below the 30.40, and so that option expires with a value, as you can see from the calculation, of $2,940. But remember, we also received $17 at the beginning of the trade, so we actually end up making a little more, $2,957, as you can see. So there's a very important takeaway from this video, and that is that you establish an options trade based on whatever your particular viewpoint is on a stock or an index. In this case, we used overnight futures price action to establish a trade plan. But once you've established your plan, you can give yourself significant room for error in the trade and still cash in if you're right about the direction of the stock or the index. In this case, we not only didn't get stopped out above our short entry price like you would have if you were trading futures, for instance, we actually would have made money above our entry price, even though that means our premise was wrong. But if we're right, the rewards of the trade can be incredible, particularly when you consider how safe we were, even if the trade didn't work out for us. Whereas with stock or futures trading, if we're wrong, we lose money immediately. And the more we're wrong, the worse the loss gets. So once you understand how to structure options trades properly, you can create these great risk-reward trade-off situations for yourself that takes so much of the frustration out of trading and instead turns all of the probabilities in your favor in many cases.
Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.